Hey folks, David here. Thanks for joining me for tonight's webinar, and we're going to get started right on time. So thanks for being prompt. I've just got a silly little alarm go off. Just let me kill that. Hang on, give me 1 second. The joy of technology. The old iPad's going off for the Zoom reminder alarm as well. So I'm doing the webinar with you tonight. Campbell's off down country, down in Queenstown, and he's on the road this week. On the scout for some new property projects that we're looking at. And so this is really an opportunity to give you an update on the Auckland market and Christchurch market. It's a bit of a national update, but I'm going to dive right down into the Christchurch market at a suburb level tonight and have a look at Christchurch from a couple of different angles, both from an orientation to the city as well as from a distance from the city as well, and look at what's actually happening on the ground data-wise in Christchurch. Quick recap on the Auckland market and a look at the last actual 6 months of data and the last 12 months of numbers just to see what the market's actually doing. Some good stuff to share with you as well from Tony Alexander, and quick website update at the end. Jump into three of our, I guess, most popular projects right now and give you a bit of an update on how they're looking and some of the good things about them. So thanks for logging in on time and being here on time. I will jump into the agenda just while we've got people still logging in. As always, if you've got questions, don't hesitate to type those in, and I'll make sure I either come to them during the webinar or at the Q&A session at the end of the webinar as well. So just take advantage of the Q&A box to type anything in you've got. And I'll aim to take a couple of breaks along the way. So, yes, the agenda for tonight, we're just going to dive into the latest with COVID-19, a bit of an update, a bit of a global view, and then talk about, in the new world that we're in right now, what does that look like, and what does it mean? Where are we headed as a country, and what's the impact going to be for us in the short, medium, and long term? A little bit at a high level, but partly from an economic point of view, but partly from fundamentally, what does it mean from a property investment point of view? So we're going to dive into that and have a look at some numbers. Bit of a New Zealand economic update, as I said, from Tony Alexander. The Christchurch and Auckland numbers in depth, and then into a bit of a project update and a bit of a tour as well. So, folks, thanks for joining me tonight. We're just getting started, and we've just had another bunch of people just log in the last minute or so. I am, believe it or not, one of those people that that's talked about on the news lately, in the sense that I'm actually doing this webinar from quarantine. I'm in an Auckland waterfront Quay Street hotel room. I've been across in Australia doing some stuff. I came back last Wednesday and into my mandatory 2 weeks quarantine. So fair to say the service is pretty good. The people are friendly. Food's delivered to your door 3 times a day. You get a bit of a cabin fever after a little while, but it's not so bad. So that's where I am tonight, and it's a room with a view. Even though there's a bit of a building in the way, I get to see the America's Cup boats go out for training with a little peep of the harbour as they sail on by most mornings. All right. So if you haven't met me before at one of our Property Factory events or online in a previous webinar, just a quick update in terms of a little bit of background. I got into property in 1990 when I bought my first house, started investing 10 years later. I've done a bunch of stuff across the years. I've seen some market cycles, made some money, lost some money, understand New Zealand from top to bottom. Built a real estate technology company that I partnered in with Campbell, and we listed that on the Australian Stock Exchange in 2015, a company called Real Estate Investor. I do a lot of sailing. I'm a passionate dad. I've got 3 growing daughters now, and I love real estate, and I love the fascination that comes with investing in property. It's a pretty cool thing to be able to do, and I love the things it creates for you in terms of lifestyle and opportunities. I joined Campbell at the Property Factory as a business partner and co-investor a couple of years ago now, and the Property Factory is really growing into quite a great team across the country who really spend their put their hearts and souls into sourcing great investments and helping investors to build their own portfolios, really. And I get to, as a result of what I spent 20 years doing, I get to go sailing about 10 weeks a year. I do a lot of offshore sailing. I've done a couple of Sydney Hobarts, and I've sailed across the Tasman 6 times. And I encourage you with your investing. Often you're so busy building families and businesses and careers and portfolios that you don't take the time to smell the roses. I encourage you, whatever your plans are, if you don't have any pastimes right now, find a sport, find a hobby, find something new to learn, find a passion. Don't make it all about work, or don't make it all about the money, because eventually we all end up in a hole in the ground and you can't take it with you. Okay, so the Property Factory, just quick introduction for those of you where this might be your first webinar. Originally founded 10 years ago. It's gone through a transformation over the last couple of years and become very digital and very national. Campbell Venning was the founder, and really wanted to solve this problem that we have across the country, where at one level we have a shortage of 50,000 houses on a consistent basis across the country for our growing population. And another level we have developers and vendors who build and sell real estate and often struggle to do that well. And then we have people who are investing in property and want to make good investments in good real estate with a good long-term story, that often find that process quite hard or quite overwhelming. And if you go to Trade Me Today or Harcourts or Ray White or realestate.co.nz, it's not that much further along from 10 years ago in terms of how it helps investors. It's really designed for owner-occupiers, and it's designed for first home buyers, but it's not really designed for investors. And so we set out to really digitize real estate from an investment point of view, and make it easy to get all of the information you need in one place online. And the history of the Property Factory over the last, going back in terms of previous businesses as well, collectively we've now sourced and sold more than 2,300 properties over the last 25 years. And we've got a team of 12 now working in the Property Factory, and it's growing by the month. And it's pretty exciting. And it's a free service to our members. You join the Property Factory, you get access to all of our investments through the website. And I'll tell a little bit more about that later. So tonight's not about making any political statements. This is a rare photo from this guy. You don't usually see him with a mask on, as you probably know. But I guess, in all seriousness, big picture right now, the COVID-19 disease, the coronavirus, despite some of the lessons we've learned in places like New Zealand and Australia and Hong Kong and other countries that have done a pretty good job, or pretty good to excellent job, really, of managing the spread. The numbers now globally are rising at record rates. The US in particular, historically a global leader in a number of different areas, has really created a lot of global uncertainty with the current leadership, and directly in terms of the US economy and the sad state of their affairs in terms of the health of their people and the millions of cases they now have. That's obviously causing all sorts of global upheaval, global uncertainty, and it's not all bad news. It's extremely sad for people in locations like that are suffering like that. But in our case tonight, what I'm going to focus on is not a doom and gloom story, but really bring it right back down to what does it mean for New Zealand investors? How does it impact you? What do you need to do differently? What can you take advantage of? And how should you approach the 6, 12, 18 months ahead in terms of the next steps that you take with building your portfolio? Okay, so I think the world's going to start to split into these kind of two informal groups, the safe countries and the unsafe countries. And I think that we're going to start to see some bilateral stuff start to happen where if you take New Zealand right now, 10% of our economy relies on tourism. You can't replace international tourists with domestic tourists alone, particularly in places like Queenstown with skiers and snowboarders. We need some level of international tourism to thrive as an economy. It's not that we can't get by with our borders closed, but it's going to be tough for some sectors of the economy and some of that infrastructure. There's nothing else you can do with that. If you think about airlines, if you think about hotels, if you think about bungee jumping, if you think about skiing, you can't change that infrastructure or that business model into something else. So that's an issue for some of our economy. There's what we're learning too is there's ongoing border vigilance required. So Australia is a very good example of that. Australia, took a slightly different approach to New Zealand, a little bit more hands-off, but managed their cases down to single digits. Maybe about 6 to 8 weeks ago, they've been in pretty good shape. And then all it took was people to come into the country, to not be managed properly in the secure quarantine they were in, to take that infection back out into the community. And now Melbourne, and the greater Melbourne area in Victoria has exploded to thousands of cases just in a case of a few weeks. And now Australia's going back into states closing off for each other and going into sort of lockdown again. So ongoing border vigilance is required. As I said at the start, I'm in quarantine right now in Auckland. I'm halfway through my quarantine, and I see the seriousness and the urgency in the Department of Health, the Air Force, the Army, civil aviation, other security people, the contractors, the hotel staff, and the police, in terms of masks, in terms of vigilance, in terms of fences. New Zealand's taking a really not tough approach, but a smart approach, and they've learned from some things that didn't go right 3 or 4 weeks ago. But we're learning to live in a different kind of world. We have to be vigilant, and just because you've stamped it out doesn't mean it's gone forever, as we know. So on a brighter note, we're going to come to this. New Zealand is seeing record immigration levels, and so that's pretty important in terms of driving the economy. Whenever we have big periods of property value growth and rental rate growth, it's because our population is growing. It's the single biggest driver, and interest rates is probably the other one that has a pretty large effect. So that's interesting. There's a lot of Kiwis headed home. There's about 3,500 arrivals a week right now. Not all of those are Kiwis immigrating here. Some of them are New Zealanders who have gone away, who are returning home as well. So, but there's even with limited flights and limited seats, and there's still a reasonable number of people arriving each week into New Zealand. We've got interest rates that are dropping well out of step with the domestic economy, and they're driven off massive uncertainty and massive upheaval. Europe, US, China relations, US-Europe relations. And so the key thing for us as investors is understanding how do those bigger picture issues affect us, versus how do we take advantage of economic factors that are occurring globally but don't necessarily affect you in your own backyard and with your portfolio. And an example is, if your income hasn't been affected by the coronavirus and your job, your income, your business is sound, but you now find yourself with dropping interest rates, which are improving your own personal cash flow against your own home that you own, which now mean that affordability-wise, you can borrow more than you could, which now means that where we see rents holding up pretty well, despite some of the predictions, that when interest rates drop and rents and yields hold up, then cash rise. And we've got a project that we just re-released last week in Christchurch. And last year when we first launched it, a year ago now, there was 3-bedroom and 2-bedroom stock. All the 3-bedroom stock sold out quickly because the cash flows were great. The 2-bedroom stock, because it's a good quality property with 2 bathrooms and a garage and so on and so forth, in this particular location, the price point's a little bit higher than average. But where it was negative cash flow to $2,000 a year last year, it's now positive cash flow to $1,200 a year this year or today because of the reducing interest rates. So interest rates are creating opportunities, particularly if you can lock them in for a long period of time and give your rents an opportunity to rise while you lock in fixed rates for a long period of time. The lowest interest rates in our history is what we're seeing, and it's certainly in our lifetimes for all of us. And it really means how do we take what essentially is the perfect storm for investors, growing population, reducing interest rates, prices holding up. How do we take that perfect storm and how do we turn that into opportunity, as opposed to sitting back and saying, well, I better wait. What if the world ends? What if? So it's never about investing blindly, sight unseen, on a wing and a prayer, but equally it's about embracing the data, understanding what the trends are, and making sure you make good decisions, because often these types of opportunities and these types of volatile environments create those opportunities if you're smart about it. So tonight's really about sharing a bit of that with you and sharing some supporting data around that to give you an idea of where the market is, particularly with the June data just in, and given we've had March, April, May, June in terms of impact of coronavirus in New Zealand on the property market and on property prices. Okay, so the ugly picture, where I follow the Worldometers website. You can just save it as a shortcut to your phone, or you can access through your desktop. But this is a global picture of coronavirus. Allows you to sort by cases per million, deaths per million, all that kind of stuff. And sadly, there's some massive out of control countries now, and I really feel for the likes of the Indias and the Asias and the Africas and the South Americas, where they're poorer countries with less infrastructure around health, where they live and trade on a daily basis in very confined environments. It's very, very hard, much harder for them to isolate themselves. And they're, particularly when they're in a hands-on labor-orientated jobs, not digital jobs they can do from home. So some pretty sobering things are starting to happen in terms of the daily cases and the daily growth of this. So I guess the picture from that means that as investors and as New Zealanders, we're getting disruption from multiple directions. We already had a lot of upheaval occurring with digital change, with the impact of digitization, automation, robotics. We're heading down a pathway where driverless cars and buses and trucks aren't that far away. In fact, they're operating already now, in some cases on a trial basis. The disruption that will occur as jobs are replaced is going to be incredible over the next 20 years, as forecast that 40% of jobs today will disappear. That was challenging enough for most people, but now when you overlay the impact of coronavirus, you overlay the impact of inbound tourism and what that means. Even if we open up our borders next year, as Australia's looking to do, it's still going to be on the basis that you need to quarantine as you come in and pay for your quarantine. So not many people can go on a family holiday for 3 weeks and spend 2 weeks on the way in quarantine, pay for the family, and then repeat it all when they get home again. So that's a fundamental issue right now that's not going to come right overnight. So as citizens, our inability to travel makes it hard. If you put holidays aside, some of us need to travel business-wise overseas. That gets a whole lot harder. But kind of as a result, we've almost been forced, if we weren't already there, into this digital change. And companies like Zoom have become the biggest competitors to Air New Zealand and to Qantas, not budget airlines. As we're starting to embrace technology because we're forced to, and starting to understand some of the benefits of it, cost-wise and time-wise, and really just how to force we have to change our behaviour right now if we want to communicate with people, outside of our cities or countries. Retail behaviour has changed significantly as well, and I've read a number of things now on retailers who say we're just not going to come back. Either we just won't get back to the level that we were pre-COVID-19 because more people have gone online with shopping and their behaviours are changing and they're embracing the convenience of that. More people by force have found all sorts of online retailing alternatives that they weren't aware of to physical bricks and mortar retailers, and so that's going to change. That changes the landscape. If you think about the amount of real estate tied up in New Zealand in shopping centres and retail shops and city centres, for some of those retailers who don't have a good enough destination experience, i.e. you can buy their book or their CD or their whatever online, that's going to cause some structural change. And if you own Westfield right now, you probably would be pretty worried about what the future holds in the next 5 to 10 years. The other thing we're seeing is, if coronavirus and some of these other things that morph out of this is a fundamental part of our future, some of us have got quite used to not going to offices. Some businesses have decided to not pay rent, big commercial rents anymore, and look at different ways of working with their employees. So I think from an investment point of view, if you're a commercial property investor, then warehousing, mixed-use industrial, those are sectors that are going to stay strong for the foreseeable future, because the irony is the parcel business is growing, right? Imports won't stop, and people ordering, having shipments sent to them by ordering online. That part of the New Zealand's growing. But if you think about, if you are a commercial investor, or you are thinking about investing in commercial, be very careful about office space investments for obvious reasons, and be very careful about buying retail stores or retail outlets. If you own your own business, don't rush into buying your commercial property outright that you occupy right now instead of leasing it just because interest rates are cheap, because you just don't quite know, what the future may hold with that. And the risk with commercial right now is there will be retail spaces and office spaces that just end up empty for months in some cases, and maybe even years. So just be careful with that stuff if you're considering it from an investment point of view, because there will be some bargains that come up in the commercial space. I think that's my opinion. They won't be overnight, but there's plenty of argy-bargy going on in New Zealand and Australia between landlords and commercial tenants, where the commercial tenants are saying we can't afford to pay full rent because our business hasn't returned, and the landlord's saying, well, I'm not getting a break from the bank, so toughen up, princess, pay the rent or I'll kick you out. So there's a lot of upheaval to come in that area. Okay, so without wanting this to be a doom and gloom session, what can you do? Well, build skills. Build skills around technology. Build skills around something you've always wanted to learn that you haven't decided to learn previously. I think Jacinda's offering free study or paid study for government paid study for down a number of angles in terms of all sorts of courses and qualifications and diplomas and stuff. Think about the industry you're in. Think about the business you're in. Think about what else you need to get good at that you're not good at today, whether that's digital marketing, whether that's other things that relate to digital technology. Think about those things, because it's pretty sobering right now if you're an airline pilot and you have no job and you actually have no future as a highly skilled person in the industry you've trained and spent your life in, and anybody else who wants to employ you is not going to put you on an airline pilot salary. And we have pilots in this country now working in supermarkets and doing all sorts of other jobs because there wasn't a plan B. We have other pilots who have invested intelligently in property or businesses and build other forms of income. So just think about those things in terms of building new skills, building other income streams, building on the income you already have and focusing on that, because there are significant opportunities out there. There are more opportunities coming, and interest rates at their lowest rates ever mean that there's never been a better time if you can buy smart debt, right? If you can take on debt at 2.5% and have income at 5%, then that ratio of rent to debt servicing, arguably that's never been better. Many of us come from an era where we had interest rates of 9%, 10%, 8%. 7.5% was the long-term average for a very long time. This is a different world we're in now, and cash rate is forecast to stay the same or go lower. So it's an interesting concept. So think about that. Okay, so the other thing I think we'll start to head for these kind of bubbles between, we've talked about the bubbles become mainstream sort of jargon in New Zealand, thanks to Jacinda's team introducing language that people could use that made sense in terms of your family bubble and your workplace bubble and things like that. We're heading to a stage where we're going to have a New Zealand, Australia, and Pacific Islands bubble, hopefully next year, if Melbourne and Sydney get their act together with getting this virus under control. You'll probably see a Southeast Asian type bubble. You'll probably see overlaps between New Zealand, Australia, and Asia. If you look at the cases the cases per capita, so if you're red, you're bad, relative to the size of your population. If you've ever played a board game called Risk, where it's all about taking over the world, this very much looks like the red people are taking over the world, and unfortunately the red people aren't the Red Army. That's the coronavirus. So the world's changing, or has changed, and it's not going to change back in the short term. A vaccine may appear at some stage, and then somehow you need to produce 8 billion of those at least, and that's going to take some time. So we have to understand the nature of the problem, understand what the drivers are, and understand how can we thrive, how can we take advantage of that, and what do we need to do and be aware of so that we don't get dragged into this game of watching Donald Trump on the news every day, upsetting somebody else or starting yet another riot or what have you, because there's issues globally and they're significant, but we've got to focus on what we can do to make a difference, because at the end of the day, I turned 50 a couple of weeks ago. For all of us, life's still ticking on by, and we still have to make plans for 5 years, 10 years, 15 years time. And now's the time to, just think clearly about what your plan and what your focus is. So I'm not going to read this line by line. This is Tony Alexander's latest update after surveying 450 real estate agents in terms of what are you seeing in the market. And I've just bolded the anecdotal stuff that's kind of important. More first-home buyers. They're now the single biggest segment in the country, followed by an increase in investors. 64% or two-thirds of investors are back in the market because of the low interest rates. 60% said they're looking for bargains. And the agents are saying, well, that's a real challenge because 50% of us are worried about the lack of listings because there's not enough. And agents have also pointed out that 1 in 3 or 37% are having difficulties getting finance. And recently I've gone through finance on a couple of deals, and one of them I'm out to 7 weeks now on my 3-week period. And I've had, I think, 4 1-week extensions now in my due diligence and finance period because of the mortgage broker needing FY20 financial accounts completed, extra information, blah, blah, blah. So you just got to get that stuff done, get your accountant onto it, ask for more time because everybody's in the same boat. And so if you see an opportunity, you're still better off going into contract on it, subject to finance, subject to due diligence, etc. Getting your finance underway, knowing that's probably going to take longer than 3 weeks, and then just asking for an extension. You can go for finance directly, get that under control, and then push the contract off to your lawyer at week 6 if you've got finance sorted at that point to avoid incurring legal costs if you don't get finance approved for some reason. So don't let the process slow you down or stop you because everybody's in the same boat. And as a result of that, developers especially have been patient and supportive because, if you're doing your best to get finance and it's taking longer, it's just life. Interestingly, 1 in 2 people say that, jobs and income are a factor. So where half the country feels, confident about income, half the country feels uncertain for obvious reasons. Interestingly, the feedback is investors not able to find the properties they want because there's a shortage, and obviously wanting to look for bargains, but only 12% of buyers feeling that prices are too high. So the balance of that feedback is there's no new flood of properties hitting the market. Because here's the thing, right? If I own a property and I'm kind of in the crap financially and I've got some headaches and my interest rate's now down to 2.5%, I can sell the property and kill the debt. But then what do? I go and rent it 4.5%. So have I made my problem better or worse? Well, I've probably made it better if I've freed up equity, but I've made it worse if my mortgage costs of say $2,000 a month and now a rental cost of $3,500 a month to put my family of 5 into a house somewhere. Does that make sense? So that's quite important. So we're not seeing the same pressure on forced sales that we saw GFC-wise when interest rates were 7, 8, 9% pre-GFC, where you could rent for less than you could own. Now it's a reverse. So that's seeing that if you look down here, the feedback is there isn't a flood of properties coming to the market, so that's good. And potential sellers actually are holding on to their properties because they think it's actually a better idea. And then you take the shift that's happening with a net loss of Kiwis, the end of the net loss. So we're actually gaining Kiwis rather than losing Kiwis because you've got people you've got expats all over the world, particularly Australia, US, UK, part of Asia, Canada, Europe, that are now starting to return home because they're starting to save in terms of their families. My goodness, what does this mean for us if we're stuck in Europe or stuck in the US for the next 3 or 4 years? What does it mean job-wise? What does it mean personally, health-wise? What does it mean if we don't go now? Or maybe we get to the point we can't get home. So that's actually seeing immigration at its highest level in 20 years if you annualize the last 3 months. And also we've actually got job numbers that have risen in May off job growth data. So, and then in a survey of mortgage brokers that Tony Alexander also did, it's no rocket science that banks have tightened up their lending criteria. They're wanting a bit more proof of certainty around your future income. Brokers are seeing flurry of first home buyers and investors looking for advice around finance, around investing. Banks have got money to lend. It's never been cheaper to borrow, but banks are less willing to lend. And so, waiting times for loans have blown out significantly. It says towards 2 weeks, but it's, realistically it's 4 or 6 weeks in some cases, particularly if you're self-employed. you've got an existing portfolio already. So just get a good broker, start the process early, and be patient. It's just a process to go through. And guess what? If it's hard and half the people give up, it's an opportunity for you, right? That's just the way it works. So the feedback is that because of the number of buyers, because vendors are becoming less willing to accept low offers, that we're at the stage where prices are starting to creep up and buyers are starting to accept they actually have to pay more for the property, regardless of what they thought they were going to have to do. And I'll show you some data to support that. Okay, so just I'm just going to take a wee stop there. If you've got any questions, fire them through, because I just want to make sure that I take a breather. And if you've got questions on what we've just covered or comments, just fire those through now in the Q&A box. I'll take a pause. I'll have a little bit of a glass of water before I continue. We're going pretty well for time. I just want to just take any questions if you've got any questions around the stuff. Okay, so Eston says, will there be a repeat available of this? Yeah, I'm recording this, and Gabrielle, our marketing manager, will publish a recording in the next 2 days and send it out to you, let you know it's available. And particularly in here, there's quite a bit of data and some quite good slides and graphs and charts to save you sitting there trying to screenshot them. You'll be able to recap on those and go through them at your own pace. So good question. Any other questions before I carry on? Okay, I will keep moving. Okay, so just I've got a hand raised there. Just type the question in, Maria, and send that through if you could. It's just easier for me to manage. I'm flying solo tonight, so it's easier for me to manage if you use the Q&A toolbox. So in terms of New Zealand's population growth, so it's forecast to grow by at least 80,000 people in the next 12 months. Historically, we've had growth of anywhere between 10 and 20,000 at a low point, average around 30 or 40,000 people a year. So 80 is pretty high. And if you think about that, add about 2.5 people per household, that's another 35,000 dwellings that have to be built in the next 12 months just to house these people, whether they're tenants, whether they're own homeowners. The other thing that's interesting is we've just passed 5 million people in March. It took us 17 years, our fastest ever 1 million person jump. So 17 years to do that. The previous 1 million person jump took 30 years, and the previous one before that, 21 years. The baby boomer generation breeding like crazy after World War II. So pretty quick growth, and that's not slowing down. Rob's just said, any comment in today's news? Americans visit Immigration New Zealand website every 30 seconds. Tens of thousands will consider shift to virus-free New Zealand. Rob, actually, it's a really good point, and I meant to add that as a bullet point to the slides. You're completely right. My point was that slide back there with the two little circles on the global map. Yeah, I think you're spot on. So if you're highly skilled right now in US or Europe or South America or somewhere, and you're saying, well, where do I want to take my family for the next 5 to 10 years to guarantee our safety and health and guarantee my job demand and job growth and salary? New Zealand and Australia are falling into probably a handful of locations that tick all the boxes in terms of economic freedom, political freedom, lack of discrimination against religion, blah, 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 blah. So we're already starting to see, I didn't see today's article, but I read an article of a highly skilled doctor, I think 2 or 3 weeks ago. She was American in her 40s that has immigrated to New Zealand already with her husband and 2 children. And she basically said, for health reasons for our family and with the uncertainty and upheaval, as well as, the economic growth reasons, that should move to New Zealand. So I think we don't even appreciate what's going to happen next in terms of the demand for people wanting to move here. And so that's going to come down to government controls and how the government throttles that, because obviously managing that in line with our ability to build houses and subdivide land and not creating massive affordability problems or job oversupply of labour type problems. So it's going to be an interesting one. So it's a really good point, Rob. We are literally going to be that 100% pure country with the America's Cup and the All Blacks. That's also disease-free as well. So it's pretty interesting. Jennifer says, what's the 80,000 forecast based on? It's just based on the current run rate in terms of the current monthly immigration, the average of the last quarter prorated, and the anticipation that it's going to continue to build based on things like the government now asking Air New Zealand to start to block bookings for 2 to 3 weeks at a time, because there's growing demand for inbound travellers of all sorts into New Zealand, and we've got 6,500, I think, quarantine beds in Auckland, I think, or is it nationally? I'm not sure. No, I think it's Auckland, and so the government's actually having to slow down inbound numbers because they haven't got enough quarantine capacity for demand. So it's based on what's actually happening, and I mean I've seen forecasts of 100,000 plus, but I just put 80,000 in because it's based on an actual number. But it's gonna the choice will be the government's and the government's policy around immigration as to what they do, because the reality is if they say we'll let in 200,000 people will show up. There will not be a shortage of people wanting to move here. It's just what the government's policy is going to be around that, given that Kiwis coming home will now become a bigger share of the numbers than they historically have been. So yeah, good question, good debate. So I don't want to bombard you with stats and data, but I do want to give you a market update, and just I guess there's some updates here, and there's some things that just reinforce what we know. So if we take the major cities across New Zealand, the 4 largest cities, Auckland's had an uptick in the last 12 months. Christchurch has had an uptick in the last 12 months. Auckland last peaked late 16, early 17. Christchurch last peaked like a long time ago. Kind of like 2010 before the earthquake, and then there was a bit of a burst with a shortage of accommodation after the earthquake as workers and people came in, and then it's been flatlining really since the last 6 years. So no real change there. Wellington continues to charge on. Hamilton continues to charge on. They're both 4 years into their growth cycles, and they've had good growth. So again, how long that lasts is not known. And now it comes down to picking opportunities within those markets, so you don't buy best house, best street, top of the market, in case it starts to flatten out. So I thought I'd just break this out into North Island and South Island tonight as well, just to give you a bit more perspective, because I know with the webinar, we've got people online from across the country, not just the main centres. So, only addition there is, Hamilton added to the chart, really following Hamilton, no surprise. But Tauranga following Hamilton, had a probably sharper upturn off the back of Auckland's growth, and there's leveled a little bit, but, Tauranga, Hamilton, Wellington, all following a similar trend. Interestingly, if you look back, 7 or 8 years, all pretty close together, plus or minus $50,000 median price wise, and even now, not dissimilar now. And Auckland obviously being the laggard there in that picture. Okay, so South Island summary, a couple of interesting things here. So first of all, Wanaka and Queenstown, no surprise, out there doing their own thing. They had rapid growth, and in a similar pattern to Auckland, but there's always a lag between Auckland kicking off and a new phase of growth. Queenstown, Wanaka following. It's just Coromandel's the same in terms of Auckland wealth, then migrating south and migrating to the beaches and coasts and so on. And I'm not just making this all about Auckland and Queenstown, or saying that it's only Aucklanders that invest in Queenstown. I'm just saying that's the cycle, okay, in terms of the lag with those type of more discretionary locations following the big drivers like Auckland and then Wellington, et cetera, et cetera. Okay, so what's obvious in that chart? 2 things. Well, if you're a Cantabrian and you didn't really like the Highlanders anyway, you probably like them even less now that Dunedin City has officially overtaken Christchurch for the first time in history in terms of median sale price. The other thing that's probably slightly even more embarrassing, and no disrespect to my Southland friends, but looking at Invercargill on the charge there, Invercargill's growing $150,000 in median price, while Christchurch is almost sat still. Not quite sat still because it's got going in the last 12 months, but all this reinforces, right, is 2 things, right? First of all, are the fundamentals good in Christchurch? Yes. Is the population growing? Yes. Is employment growing? Yes. And actually, there's a lot of expats returning to Christchurch. Okay. Is Christchurch a better place to live for the fundamentals, put aside the rugby team, than Dunedin and Invercargill? Well, history says yes. So eventually, it must come to pass that either 2 things happen. Dunedin and Invercargill don't grow anymore, or Christchurch starts to return to equilibrium, which if you look at that graph, there with the New Zealand average, it's just fallen off the New Zealand average in the last 5 or 6 years, and there's no reason why it won't catch up. So that just reinforces the fundamentals. So that's good. Okay, so in summary, the two outliers, Auckland's an outlier because it's had its flat period and ready to go again. Christchurch is an outlier because it's fallen off the pace, but they're the two outliers nationally, and that hasn't changed. And that's a similar picture to always. Well, sorry, not always, but at least the last 12 months. Okay, so I want to dive into Christchurch in a little bit more detail, and then I'm going to come back to Auckland. And you haven't seen this information before because I put it together today. So if you have seen our market updates on Christchurch, stay with me because I'm drilling down to a deeper level. So Christchurch, like Auckland, like Wellington, like any part of the country, has some fundamentals that make it different for different reasons. And I really wanted to dive into those. But, to familiarize you with it, there's the CBD there where that big red flag is, with the 4 Avs. East of the city takes you to the coast, northwest of the city to the airport. But one of the things about the greater Christchurch area is all this land, right? All this land, miles and miles and miles of farmland. So in terms of when you think about investing in what's called greenfields versus infill housing versus CBD areas, you've always got to weigh up, okay, where will there be most demand over time? And where will there be the lack of availability, or where will there be more scarcity? And the danger always is if you invest in brand new greenfields areas, while they can be good value for money and blah, 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 because developers can continue to subdivide and release new developments indefinitely, then what can often happen in the first 5 years, because there's so much supply if it's not managed, because of multiple developers bringing property on stream all at the same time, they can often suppress price growth of those existing properties because there's so many people just buying new properties. Because the concept is, right, why would I pay you more for a property that's 2 years old if I can just go down the road to XYZ developer and buy a new one, and they'll throw in a furniture pack and this pack and every other pack? And that's what happens when there's unlimited supply. If you take a boutique apartment building in a city, when there's only 30 units available and on both sides is retail shops and office buildings and so on and so forth, well, there isn't necessarily unlimited supply next to it, all around it, across the road from it, unless developers tear down other buildings and so on and so forth. So just think about those things, because they are factors where people often get confused and they say, oh, well, I found this really nice place out of Kaiapoi, or what do you think of the inland port at Rolleston, or West Melton looks really nice, or Templeton's really growing massively now. Yes, and yes, but it comes back to what are the drivers, and it's not that those places won't grow in value over time, because they will, they just will. But it's all about, if you're in the early stages of your portfolio, where are you going to get better than average results? How do you get into the right locations at the right time so you're straight on the travel later, like Auckland and Christchurch right now? But then within that, how do you find the best locations within Auckland? How do you find the best locations within Christchurch so that you get better than average results? Because it does make a difference. And it's the same across the country, but tonight we're using those two examples. So Christchurch City, this is a 10-year graph, and New Zealand's trend, the Christchurch trend. Flat period post-earthquake, rising period in the aftermath when there was a lack of supply and people returning to town in contracting roles and tradie roles. A big flat period from mid-15 through to mid-19, and then the new cycle of upward growth, which I'll show you data on today, has really got going in probably the last 12 to 18 months on average, but I'm just talking about averages. Okay, so a lot of people, when they think about investing, they think about the ripple effect, right? The concept that growth starts at the city centre at the start of a new growth phase and moves outwards into the fringe suburbs, into row 2, row 3, row 4, and then out into the suburbs and so on. Starts at the big cities, moves to the smaller cities, starts at the cities, moves out to the regions, etc., etc., etc. Starts in Auckland, 2 years later flows into Coromandel, flows into the Bay of Islands, flows into Queenstown, etc., etc. So that's generalizations, but it's called the ripple effect. And while there's some truth to that, it's not always an exact science, and you can't take it for gospel. So what I thought I'd do today, just to fill in 5 hours and prepare something different for tonight's webinar, is drill into some data around this to really help look at this and explain in terms of city centre versus first ring of suburbs outside of the city versus the suburbs that are 2 rows deep. What does that look like? And, I've pulled the data in terms of median price in June 20, June 19, June 18. And then I've grouped those suburbs, right? I've grouped Christchurch Central inside the 4 Avs. What does that look like? And this is house and townhouse data. I've kept apartments out of it because I just want to try and get like for like across the board. So we're using actual data and not anything fudgy, right? So interestingly, if you just generalize and say in a city inside the 4 Avs, what's the growth been like? And in the last 2 years, it's grown a total of 23%. If you say, okay, the suburbs that are wrapped around that city centre, theoretically, according to the ripple effect, they should grow next fastest, right? And in the last 2 years, those suburbs have grown 8%. Interestingly, the suburbs that are 2 rows back have grown 12% over the last 2 years. And even if in the last 1 year, it's slightly faster. So, and I'll come back to why I think that the ripple effect doesn't apply verbatim in Christchurch, and I'll show you next. But interestingly, if you take all of Christchurch, like the greater Christchurch area, then no matter what, if you've bought in city centre, row 1 or row 2 in terms of suburbs from the city centre, you've still done anywhere between 1.5 times and 4 times better in terms of growth rate over the last 2 years, because Christchurch City, the greater Christchurch City, 4% growth the last year, 5% in total over the last 2 years. So just I thought I'd share that with you so you can start to see that. So the concept is that the closer city outperforms the wider region over time, because there's a finite amount of space in the city, traffic starts to get more congested, there's increased demand for a finite amount of space, but it's not just distance to the CBD that affects that growth data. Okay, so in terms of that ripple effect, here's how it looks. So inside the 4 Avs, 23% growth in 2 years. First row out, 8%, 2 rows out, 12%. And then the greater area plus those areas, so all of Christchurch City, 5%, which probably means in real terms, if you were to take these areas out, it would probably actually be 4% or 3%, because these areas, of course, are lifting the average. So I just wanted you to sort of get your head around that, okay, in terms of the impact on those things. The other thing that's quite unique about Christchurch is, I call it the orientation effect, okay? Christchurch is unusual. In most major cities in the world, as you get closer to the water, the real estate values increase, okay? As you get closer to the airports, it's generally out in the burbs, real estate values can decrease. Auckland's an example of that. Wellington's probably not an example of that. Hamilton, I don't know. Queenstown is, but Queenstown's Queenstown. So with Christchurch, what I've done is I've taken the city centre and I've said, okay, let's sort the results into everything that's north and west and northwest of the city, because in Christchurch, the most valuable real estate on average is between the city and the airport, particularly Maryvale and Fendalton. And also, on average in Christchurch, the real estate closer to the sea or more east of the city is lower value real estate, lower socioeconomic areas. Now, I'm generalizing because Cashmere, Sumner, some of those areas, quite valuable real estate with elevation, Port Hills, views of the sea, etc. But that's a fact in terms of these areas east of the city. And then I've sorted out this group that are south and southwest. And then when we look at the information there, we can actually see a pattern now. Okay, so if we look at Central City, north and west, 12% growth in the last 2 years. If we look at south of the city and southwest of the city, 11% growth. And if we look at the east of the city and that northeast, east, southeast area, 6% growth. So I wanted to share that with you because you can't just take statements like, the closer you are to the city, the faster the real estate will grow, because there's still variations, right? And I know that you know that, but I just want to use this as an example of really having to explain and illustrate how that is and how that trend makes sense. And even within these areas, you can see there's top performers, and you can see there's performers that don't quite make sense. Now, just be aware, median sale price data doesn't necessarily mean every property's gone up in value at this rate, because when we take all houses and townhouses, if there's a growing number of properties built on smaller blocks of land or smaller sections with smaller bedroom numbers, then arguably that could be reducing the median price. Whereas the median price 10 years ago was probably 3-bedroom houses on a 900 square metre section. Today it's a 2.5-bedroom house on a 400 square meter section, if you know what I mean. So don't always take median data as verbatim either, because it's an indicator, but it's not the be all and end all. It's just a crude way of comparing like for like, but it's not an exact answer. So again, lesson here is shorter distance from CBD is not a guarantee of faster growth. You've got to understand the lie of the land, local nuances that drive those different markets, because in this example, when I bring it back to the illustration, you can see there's quite a marked difference if you're east versus west of the CBD. Okay, so I'm going to just take a couple of questions there. So Liz says, can you talk about the impact of tourism downturn on Christchurch? So not at a deep level, Liz. I'm not going to pretend to be an expert on Christchurch tourism. Christchurch is the gateway to the South Island, and it's where our international visitors predominantly arrive. A large number of tourists arrive into Christchurch and depart out of Auckland. And it's got a lot of infrastructure around tourism, including hotels, etc. And so, there's definitely been some impact for Airbnb operators across the country. Domestic tourism will replace some of that. We're going to see, or we have seen already, some of those Airbnb properties converted back into long-term residential tenancies. That will start to help to arrest some of the issues that might occur with over-demand, with rising immigration and enough new properties not being able to keep up with it. But absolutely, Christchurch will be impacted as much as Auckland in terms of tourism as a percentage. In places like Queenstown and Wanaka that are tourism heavier, probably going to be impacted more. So yeah, it's I don't want to generalize, because there is an impact nationally, and even if you're not in a tourism business directly, you benefit from tourism because you probably have people that are employed by tourism who spend money in your business. Even if you don't have tourists shopping directly in your business, you don't have to be a tourism operator to be affected. So, it's an impact. The key thing is whether you're employed or unemployed, you need somewhere to live, and our population is not getting smaller, and so really it's going to be the structure and location of where that real estate is. The benefit for Christchurch it's a very affordable place to live, because rents are well below Auckland and Wellington, and they're below Hamilton. Purchase prices, you can buy, people are still buying one-bedroom properties today in the Colombo Street project for $344,000. I mean, that's $450, $500 in Auckland. It's $500 in Wellington. And when I say $500 in Auckland, it's out, it's 30 kilometers out of the city. It's not in the city. These are in the city. So, it's, as long as we've got low interest rates, I think it's going to help to cushion this to some degree as well. Matt said, have you looked at these metrics over a 10 or 20-year period? No, Matt, I haven't. I have at a macro level, but not at a per suburb level. And certainly that's a project I can do next. And I have to manually pull this data. It's not an automated process. I manually pull it from the INZ website. I'll take note of that and look to do an update for next month's webinar, and look to extrapolate it out further over a longer period of time as well. So purpose to know is just to give you the lie of the land in terms of what's happening right now. So in terms of drawing those lines on Christchurch, you can see there east of the city centre, south and southwest, north, northwest, northeast. West, northwest, and north, and start again. West, northwest, and north. That's it. So helps you to understand the lie of the land. Of course, Auckland's very different because it's driven by different dynamics. Okay, so I don't want that in there. So in terms of growth rate, does it matter that much? Well, if you're in an early stage of building a portfolio, you argue that it matters quite a lot. If you've already built a portfolio and you look back over the properties that have done amazing things, that have doubled in value and doubled again, versus those that have gone okay and might have grown 50%, you'd argue that, capital growth does make a difference. And for most of us, the bulk of our wealth comes from equity creations through capital growth. Absolutely, we're building passive income over time. But even when we get to retirement stage, and we've built good cash flows, we've still got a growing nest egg in terms of that equity. So consider that, because it does make a difference. And don't just fall in love with a house and say, well, the rent's great, so whether it's 5% or 7% doesn't really matter. Well, it's the difference between you having enough equity for 2 more deposits, or for 2 more properties in the next 5 years versus waiting 10 years. So it does matter. if you think about doubling a property's value in 10 years versus 15 years versus quadrupling its value in 15 years, that's a big difference. So think about that. So in the Property Factory website, when you drill into the analysis area, we automatically sort projects a number of ways that you can see and analyze. And one of those ways, to Matt's point, is taking the 20-year growth history in terms of average annual capital growth. And we sort projects from top to bottom on yield, on capital growth, on total combined, etc. So use that data because it's there for that reason. So you can take advantage of, knowing what's the best, what's the worst, etc., etc. And when we say worst, they're still good projects. It's just, some are great and some are above average. Okay, so do your research, buy on the numbers. Okay, so just a real quick recap on Auckland. Not going to go into it in depth like I have on Christchurch, but an update nonetheless, because it's important if you're investing in Auckland right now, as a number of investors are, it's important to get an update and understand what the market's doing, particularly on the back of Tony Alexander saying, guess what, the market's not collapsing. Jennifer says 7 minutes left. Are you going to be talking about all today as promised? I hope so. I'm going to keep going. I'm probably going to finish in about 15 minutes, Jennifer, but if there's anything I don't cover, feel free to ask about it in terms of content. Okay, so at a regional level, so the old Auckland territorial authorities, this, as we said last month, almost all of Auckland, not all of it, but most of Auckland's into its next upward growth phase after being relatively flat for the last 4 years. And leading the charge, Auckland City, North Shore City, those more affluent areas have got going again. Waitakere City as well, seeing some growth. Okay, so what I did is I pulled actual January through to June data this year, and largely Auckland's flat. Other than Papakura, there's a lot of houses being built in Papakura right now, and it is 40 kilometres from Auckland CBD. But other than Papakura, I think all the other areas are either at or higher than where they were in January. And we see there that, we had properties that probably went into contract in March. That's January, February. That settled March, April. Their prices were rising, come off the boil a little bit in May, June, but basically flat. And then I pulled the latest data by territorial authority, June versus 12 months ago, and June versus 3 years ago. And you can see there, double-digit growth. North Shore City, Auckland City, and those other locations led by Waitakere City, starting to come along pretty strongly. And if you look at growth in 12 months versus 3 years, you can see that clearly, if you think 15% growth in a year versus only 10% over 3 years, then clearly Auckland City's come out of that downturn and gotten back into that uptick in terms of it's into the next growth phase. So that's encouraging. Prices are staying up. Prices have been supported. And, if you take a 10 and 20-year view with all those areas, Auckland is safe as houses. It just grows and grows and grows and grows and grows. However, some parts of Auckland grow faster than other parts, and that does make a difference over time. So consider those things. And, we're putting a lot of focus into the Waitakere City area. That had, over the last 20 years, was number 3 in terms of growth. Over the last 10 years, it's been leading the charge in terms of total growth over that last 10-year period. And it's got some key drivers that are driving that. But again, if you drill down into Waitakere, it's not, all suburbs aren't created equal. There are locations in there that over the last 10 years are growing at 9% compounding growth. I mean, 9% compounding means they double in value every 8 years. So again, we put a lot of work into research and analysis because it makes a difference. It makes a difference. And there's reasons for that, proximity to the city, proximity to the motorway, et cetera, et cetera. So do your research. But West Auckland, in terms of it being part of that territorial authority of those 6 or 7 areas in Auckland, if you count Franklin as well, it's, the motorway widening is taking forever, but it's improving travel times to the city most of the time. Te Atu Peninsula has gone through a massive change over the last 10 to 20 years from the state housing area it used to be. And it's 13 kilometres to the city. And so Te Atu Peninsula, Te Atu South are seeing the benefits of that in terms of capital growth. Growing employment hubs in Henderson and Westgate, the motorway tunnel linked to the airport, the Southwest Tunnel, and that motorway link across the Greenhithe Bridge area to the North Shore as well. And, train infrastructure too. So Auckland is solid and, again, full of opportunities, but equally just be careful. There are areas where there could be oversupply in the future, or very flat prices because of the rate of construction. And I'm not saying that's going to happen in Papakura, but it does, driving through that area, there's a lot going on and there's more land to be chopped up. So you've got to be careful. And it's a long way from the city. However, you can live in Papakura and work in Papakura and never go to the city, or you can work in Manukau instead if you want to as well. It's not that you have to go to the city. So a couple of things I want to draw your attention to before I jump into the sort of final Q&As. Take advantage of the investment capacity report that we produce for our members. It's free to be a member. You just join the top right-hand corner of the website. Members dashboard leads you to a number of things in terms of our current projects, as well as the ability to request an investment capacity report. You'll get a 6-page report that gives you 3 different scenarios based on your exact starting position today, and then when you could end up in 10 years' time based on buying, 15 years' time, 10 to 15 years' time based on buying 1, 2, or 5 investment properties over the next 10 years. So we produce that for you using a whole lot of averages analytics and just help you to see what the potential is. So to take advantage of that. Right now, our 3 most popular projects, Glen Eden, one of the high growth areas in Waitakere City, Colombo Street. Of that project of 68, I think there's about a dozen left now. All the 2 bedrooms are sold out. There's still 1 bedrooms left. They're great cash flow properties. They are the cheapest 1 bedroom properties in Christchurch, in the Christchurch CBD area, and then Rustley, the Rickenink Racecourse that we've just released last week. So just give me 1 second. I just want to show you a couple of things online, and I'll go to the sort of final Q&A session. Okay, so you should be able to see the website. So as I said, to join up as a member, top right corner, there's no catches, just sign up. Once you sign up, you log in and it just remembers you, and you just can log in whenever you want. The current projects area allows you to see everything easily across the country. If you love mapping, if you love visual stuff, you can dive into a specific project and see exactly where it is. It's some really cool tools. And from there, link straight to the website. We talked about the ability to focus on numbers. If you go into the project ranking by performance, you can automatically see the highest cash flow properties, the highest capital growth properties, the highest cash flow and capital growth properties when you combine yield and growth, and then probably sorted by price as well. And you just click on the link and it takes you straight to the project. So take advantage of these tools because it's never been easier. And we love the fact that probably our members have become even more digital in the last 3 or 4 months than they were as a result of, some of the COVID-19 issues. I'm going to jump into a couple of projects now and just give you a quick update on those. So Glen Eden is a great project. I think it's 47 units. There's 3 left now. It's architecturally stunning and it's very, very different to anything we've done previously. It's built by GJ Gardner. Price points around $599 to $639. It's positive cash flow. It's got some good deals in there in terms of legal fees and discounted property management and fridge, freezer, heat pump, etc. Go in there and check it out. It's a really nice little development, really, really nicely done. And it's going to be popular with tenants. It'll get great rents. It's positive cash flow. It's in a suburb that's grown more than 100% in 10 years and more than 300% in 20 years. It's that super growth type location. And when you look at the project itself, it's really, really good looking. It's a really, really good looking project. So in the website, there is, where is it? There's 3 left. 3 of those left, 629. So go check that out. They will not be around for long. The other thing I wanted to draw your attention to was the new Rustley project. So this is a project with a bit of a twist. It's it's not in the Christchurch CBD. It's not in the first 2 rows of suburbs. But the thing about this project is it's nicely located on a road that takes you to the city and to the airport. It's 6 minutes from the airport. I think Christchurch Airport employs 5,000 or 6,000 people. The developers now sold, I think, 9 of the 16. These are 2 bedrooms. They're all 2 bedrooms that are left now. They are positive cash flow. They all have 2 bathrooms, and they have a garage as well. And what makes this development unique is it's literally on the edge of a racecourse. So if you think about, close to the water, close to the city, close to a park, close to the mountains, and this is on the edge of a racecourse. These are all between 518 and 528,000. They're below market valuation. And if you look at the setting, they're beautiful properties, really nicely done. If you look at the setting, that stage 1 area in there, that's where they're located, next to the Riccarton Racecourse. So the Riccarton Racecourse is not in Riccarton, believe it or not, it's in Russley. Russley is an established suburb. It's basically got no more room to expand other than these little areas around the Riccarton Racecourse. Stage 5 is a massive golf driving range. The owner of that doesn't want to sell. At the moment, it's only stage 3, 2, 3, and 4 that can be developed, I think, in future. But stage 1's been completed now. Construction is underway. It's due to complete November or December. But great project. If you want something different to an apartment or something different to a side-by-side type townhouse type structure, these are architecturally stunning. And with garages and 2 bathrooms as a 2-bedroom, that's pretty unique. Builder's been it's got a 40-year track record in Christchurch. Bainbridge is the developer. Good guys, good business. Do a good job. So go check that out. And then Colombo Street, I won't dive into that in any great detail. We've had a great success with that. That's been our biggest project to date, and most popular. It's just cheap, great quality, great yields, great rents which are rising, a waiting list of tenants, and $340 for a brand new high quality inner city townhouse is just a great price, or $360 with a car park is just a great price. So there's only 1 bedrooms left now. I think out of the 68 or whatever there is in the project, there's about a dozen left. So take advantage of that. Okay. So in terms of the members dashboard, make sure when you log in for the first time or log in tonight, go to the investment capacity report, fill in your details, send it through, and we'll get that report out to you within 7 days. So take advantage of that. Okay. The other thing I want you to be aware of as well is there's a whole lot of community resources in here as well for members. So we've got a Facebook group that you can join. There's market updates we do, other videos. There's a podcast we publish, and also property analysis software that's free for our members to download and use. So any of the software, any of the analysis reports you see us do on any of the projects, you can download your own version of that. Microsoft Excel, put your own numbers in, do your own analysis. So you should have a copy of that sitting on your computer so you can do your own numbers, because we do numbers based on certain assumptions, but your numbers might be different. So take advantage of that. Okay, so I'm going to jump back into here, and we're going to go to the sort of final Q&A session. I can see a few things in the chat box as well, so I will go to the chat box too. Okay, so talk to our team. We've got a team across the country. Get your investment capacity report. Look at the deals, learn the numbers, understand the numbers. Just even if you're not in the market right now, even if you're just going for finance because you're not sure, start looking at projects. There's no stupid questions. There's stupid answers, but there's no stupid questions. So ask any question. We're here to help. We're here to educate you. We're here to empower you. And we want you to learn and develop and build your portfolio. Okay. Jennifer, so if you've got more questions, Jennifer, let me know. I'm going to go into the chat area. Okay, so there's some chat in there. Oh yeah, Rob, I've answered that one. Adrian, I've got a 4-bed in Marshlands that's averaged 2% a year for the last 4 years. Should I sell to buy in the 4 abs? Yes, so Adrian, I think it's a great question, and I've learned the hard way a couple of times from not cutting my losses early, and I'm not telling you to sell, just in terms of giving you financial advice. But you have to weigh up: is it going to magically get up and outperform the average? Is it going to catch up to the average? Is there something changing that's going to drive it, or is it just going to underperform? And that's, Marshlands is in that northeast area of Christchurch, so sometimes it just pays to get off the stairs and onto the travelator. I tell this story, but I bought a rest home in when was it? In early 2000s in Upper Hutt, and it was a bargain. got 60% finance from the bank, 40% from the vendor. So I thought I was a rock star. Anyway, this thing was just a nightmare. And the value didn't rise for 4 years. And I lost money and I lost money and I lost money running this rest home at a loss because I won't bore you with the details, but it just wasn't smart. I lived in Auckland. It was in Upper Hutt. And eventually I sold it after 4 years. And I should have just sold it after a year and cut my losses. Because I waited 4 years, I lost $200,000 in negative cash flow running that business for 4 years. I could have just taken losses of probably 30 or 40,000 after year one, put my money into something else and got back on the travel agent and moving forward. So yeah, if you find yourself in a low growth location and that's the longer trend or a below average location, sometimes you're just better off, biting the bullet and getting out of it. And it's not a bad location because somebody who just wants to live there and live in it as a home and doesn't really care about capital growth and isn't planning on investing might just say that's awesome. But if you're looking to grow your equity base from a personal point of view and reinvest in property, then it does matter, particularly in the early stages. So yeah, good question. Next says, which is the best area to invest in Christchurch and why? Oh, that's a great question, Nick. How is rental demand in Christchurch? What is average price for 3-bedroom freehold property in Christchurch? Okay, so probably, Nick, I'm not sure if you might have asked that question before I ran through the Christchurch data, but there are multiple locations in Christchurch that are good to invest in. There are multiple locations to avoid. The average price for a 3-bedroom freehold house in Christchurch, I've got the median price for houses and townhouses for Christchurch, which is the greater area. I think from memory that's $490,000. But in terms of investment stock in the right location, 1-bedroom stock from mid to high 300s, 2-bedroom properties from low 4s, 430, 440 to 500, 3-bedroom properties around the 550 mark. We had some stuff a year ago below valuation at 530 with valuations of 560. But really for the average, if you're talking about 3-bedroom property on house and land, you're probably talking about 570 to 700 in locations that you get good growth from. Not premium locations, but there'd be locations where you could pay less than that, but there would be older properties where you might have growth issues. So again, Christchurch is made up of a number of locations and price points and dwelling types. We just focus in on breaking the city up, looking at the opportunity, the areas that are opportunities, finding projects within those areas, and then also making sure that the numbers make sense rental yield wise, demand wise, etc. Rental demand in Christchurch is strong. I understand from Max Property Rentals that we spoke to, and I think we did a podcast on that a month or so ago, that their biggest growth right now is returning Kiwis who are expats. In terms of the city centre itself, the international returns are ahead of domestic transfers into the city, and they've got a waiting list for properties from tenants, particularly for that Colombo property. So again, you can still buy a property in a crap suburb that's not well presented, and you might struggle to rent it. So it's horses for courses, but hopefully that helps give you some guidance. Sinkin says, do you have anything else for Auckland in terms of, I think that might be properties. We've got a number of new projects we're working on Auckland-wise, so watch the space. We've got Auckland's a real priority. We haven't been able to keep up in Auckland. But again, we're after great projects. We could just go and fill our website out with projects that are C and B grade projects, but it's just not our focus. It's not our commitment to you. So we are after positive cash flow projects, fully geared in growth locations. And so, we turn away 9 or 10 a week that aren't, but we have got some in the pipeline, so watch the space. Adrian says, thank you. You're welcome. Lynn says, what do you predict for the central Auckland apartment market? Oh, that's a really good question, Lynn. In fact, we were just we had a property strategy meeting this week with our acquisitions team. And I mean, the fundamentals for Auckland long term, it will just keep growing, and it's a powerhouse in terms of the economy and the population. Everything. I haven't looked at the apartments recently, but when I last looked at the apartment market earlier this year, there still appeared to be an oversupply. The price points were high. It didn't make sense to me when there was stuff that were in the 7s and 8s in terms of 100,000. What the rental yields were. And I'm not an expert on the Auckland apartment market right now, so I'm not telling you to do it or don't do it. Just the fundamental suggestion that there was still an oversupply issue, and I couldn't see capital growth occurring in the apartment market like I can see it occurring Auckland City house and townhouse dwellings, North Shore City house and townhouse dwellings, Waitakere City dwellings. I can't see apartments stacking up ahead of that. So that's kind of a watch the space for me right now. And again, that's a generalization in terms of the general market. You'll always find amazing boutique projects that do great things because of the locations they're in, and you'll find lesser quality, lower price, less attractive projects that may not perform as well over time or have other vacancy rate type issues as well. Okay, so just a couple more questions coming through. Turnkey says, what experience do you have with buying townhouses versus buying houses with bigger land and some potential to add dwellings or renovate? I think that looking at the current cost of subdividing and developing, all the fees and costs involved, the development levies and the council contributions, that it's not easy to do unless that's your game. And you've got to know your stuff because it's a costly process and you can overcapitalize. So, I never say don't do it, but I'd say if you're going to do it, you've got to do it well. You've got to know your stuff. There's a lot of people that have bought property on the basis of renovating and or subdividing and or adding extra dwellings, to find that by the time they spent the money and all the extra costs they didn't anticipate and paid all the fees, they haven't made the gains that they hope to make. And, I've personally subdivided. I did a half-acre subdivision from a single dwelling into 3 dwellings on 3 sections in Glen Eden some time back. And my experience was, while it was extremely profitable, because it dragged out to 2.5 years because of consent issues, neighbourhood approval issues, driveway upgrade issues, delays with building consents, etc., etc., etc. I could have made the same money 3 times over in 3 different property deals in 2.5 years without all the stress and time and hands-on work. You've got to be prepared to project manage it to make money. If you just throw money at, a design build company, well, they'll take half your margin because they just do. That's the business they're in. So unless you project manage it yourself, you don't really get the full margin. I know a lady in Hamilton who asked us for advice. She was chopping off a back section in Hamilton. It was going to be worth $120,000. She was paying one of the housing companies, which I won't name, to build a 2-bedroom house on the back of it. It was going to be worth $500 in the end all up, and it cost for $450. And so it didn't make sense because she was turning a $100,000 section into equity of $50,000. In other words, she was going backwards because of the extra she was paying the other companies to do all the work. So unless you're prepared to do the work, I think, and I've done a lot of renovating in the early days, definitely not the last 5 years. I just buy new now because the cash flows are so good and it's just stress-free. And I've subdivided and developed, and I've hired the builders directly myself. I've bought the materials myself. I've paid for the architect myself, the town planner, the surveyor, etc. So I understand the process. And all I know is you've got to have a good team around you to make the margin. If you just pay middlemen or middle people, that you can lose a lot of margin. So I'm not trying to say don't do it. I'm just saying, know your stuff. And you've got to put the time into it, and you've got to have the time available to put into it because it can be stressful at times as well. Okay, some more questions. Virginia says, thank you, David. It really helpful. Got to go. Sorry, that's okay. Nick says, what do you recommend where to buy investment properties in New Zealand, especially cash flow positive properties? What do you recommend to buy new or old property and renovate? So, Nick, we completely at the Property Factory focus on brand new property. For a bunch of reasons, which I won't recap on and give you the sort of half-hour version, but new property, minimal or no maintenance, happy tenants, premium rents, positive cash flow, good locations, rising values, healthy homes, et cetera, et cetera, et cetera. Always positive cash flow is our focus. We've got one project on the website right now, Maryvale, which isn't positive cash flow, but that's a blue chip location in Christchurch, and that's sometimes going to be an owner-occupier or first-time buyer type property, but that's an example. So new, we don't buy old property. It's harder and harder and harder to renovate and upgrade and manage the costs using contractors and make money. You go, you think sometimes you're getting 7 or 8% yield, but if you lose 3 or 4% in costs and maintenance, by the time you pay your other overheads and your interest rates, often you're no better off than just having a brand new set and forget happy days property that you don't have to do anything with for the 10 years. So That's our focus. Where to buy? Auckland and Christchurch are our big focus right now because of the fundamental drivers of those locations. I'm not saying they're the only places, but they're just, the primary cities, the primary waterfront locations, the Coromandels, the Kaiteri Terries, the Queenstowns, the Wanakas. Those blue chip locations are going to give you growth over time. The challenge with a lot of those is the yields are low and you can't afford to fund them. So we focus on the locations within cities that are affordable, that will give you great growth over time, and locations that make sense, that are also price points that make sense. Because ideally, you want to build a portfolio and get to 5 properties as quickly as you can, because your risks are massively reduced. Because at that point, you have 1 property empty, 4 properties cover all your costs. Or in the current environment, you have 3 properties occupied, 2 empty, you're still covering your costs. So risk management wise, it's much better than having only 1 investment property and it's $1 million, and now it's empty. And now you've got to pay that mortgage plus your own mortgage, and now you're stressing you think investing's a dumb thing. So from a risk management point of view, we focus on below median price point, because you're always going to be able to resell it if you have to first home buyers, owner occupiers, people trading down, other investors, etc., as opposed to buying those $1 million or $2 million blue chip properties in an early stage. So our website's full of research and analysis. Take advantage of that and book in a time with one of our team to talk through that in detail as well if you want to, because we're here to help. Banks aren't lending that much these days. Banks are lending. They're just being selective on quality of property, quality of lender, quality of your income. So you've got to line the ducks up. So arguably you want good quality properties. Okay. Two other questions. Do we need to be in a position to invest now and have lending approval before we start working with you guys to learn about properties, get advice, etc.? Or are you open to working with people who are still saving and could be 6 months off? Great question. Unlike any other company, you're not paying for our services, so you should start working with us as soon as you're ready to. But yes is a short answer. We usually start off working with people that are either existing investors wanting to look at how they take their portfolio to the next stage, or brand new investors saying, how do I get started? What do I need to do finance-wise? Where should I go accounting-wise? Who's a good property manager? Which projects or price points make sense for me? What do I need more of, capital growth or income based on my current position right now? So you can start working with us straight away, Easton. That's the service we provide. And when I say our services are free, we are a buyer's agency. We are a licensed real estate agency, licensed under the REA, just like Bailey's and Harcourts and so on and so forth. Unlike those guys, we work specifically with investors and first home buyers. We focus on new property only. We provide a members only service that's free to use. We get paid a marketing fee if we sell their project, just like anybody else who sells their project, whether it's a Ray White or a Bailey's or what have you. We're a licensed real estate agency, except our focus is the buyer. So we're loyal to the buyer, and we help them work out which project makes sense, as opposed to being loyal to, we must sell this project for this developer if it makes sense. Hence why we work with a number of developers across the country, a number of different projects, and we're not loyal to any one developer. And if you just take one of the developers we work with right now, we don't even list and sell all of their projects. We only list the ones that we select and meet our criteria. More of their projects in Christchurch than not don't meet our criteria, so we just focus on the ones that do. It's not to say that they're not good projects, but in those locations, they're in suburbs where the prices are higher and they're more designed for owner-occupiers than they are for investors, because the yields don't make sense for an investor. So start straight away. The contact details are on the website for our team, Easton, so just reach out and we'll request an investment capacity report and we'll start the conversation. Okay. Jennifer says, how can you check out the developer when signing up for a project under construction? Do developers normally commit on paper for a completion date? So good question. So one of the things we specialize in doing, which takes us basically selecting a project and assembling all of the information and doing all the due diligence on the developer on the project, takes us about 60 hours. And then once we tick all of those boxes, including vetting their contracts, checking all the clauses, inclusions, due diligence details, settlement dates, all that kind of stuff, checking how they're funding it, making sure they can afford it, their track record, their previous projects. Then we get to the stage where we're ready to put the project on the website, and then that takes us about another 40 hours to do all the cash flows, rental assessments, package it all up, make it look beautiful, so you can just press a button and there it is. So we do a lot of that stuff for you. But certainly, Jennifer, when you go into contract on a project, it's usually subject to finance and it's subject to due diligence that your lawyer will then do for you and go through that contract in detail and make sure everything's covered and under control. By law in New Zealand, if you take a typical property factory project, when you go unconditional, you pay a 10% deposit. That goes into a solicitor's trust account. The developer can never touch that money until the title's issued and the code of compliance, and you're then ready to settle. The developer can't touch the deposit. It's in trust account. So if for any reason the project is delayed, if it goes past what's called the sunset clause, or the date they have to complete the project by after the target date, because there's often delays with weather and resource consent and so on and so forth, then if they don't complete the project for any reason, if it doesn't get built, if title doesn't get issued, if code of compliance doesn't get issued, you get your deposit back. It's protected by law in a solicitor's trust account. So there is a target completion date in the contract, and there's usually a sunset clause of usually up to 12 months. Because for whatever reason, so if you take one of the developers we work with, they're really intelligent because they design their projects, they release their projects, and when they get to the point where 60 to 70% of the project's been pre-sold, it's what's called pre-sales, by the property factory, then they say, great, 70% of the project's now confirmed, we'll now start construction. The bank allows them to draw down their construction funding, and then they'll start construction. They'll complete their project over, say, 20 weeks while the balance of the project's been sold. So sometimes, they hit their pre-sales target in like 3 or 4 weeks. Sometimes it might take 3 or 4 months. So there's a bit of wriggle room there. But yeah, we hold your hand, Jennifer, because that's what we specialize in, and we understand development. Campbell has had a history as a developer for 3 years, developing property. We've bought and sold ourselves off the plan. We invest ourselves off the plan. So we understand the stuff, and we employ our own contracts manager in-house who's a specialist who understands off the plan contracts, so we can make sure everything's covered. Okay, one more question from Nick. How long does it take to build a new house with developers? Do you think the new build price is fixed and turnkey? Oh yeah, so good question. So 3 very good questions, Nick. First of all, everything we do is fixed price. So that means if you buy the property today and it's ready built, as the Fletcher's project in Christchurch is in Colombo Street, you purchase it today and you're generally going to settle within 3 or 4 weeks of going unconditional. If you buy that project in Glen Eden that I talked about, that's $599,000 or $629,000, I think, in terms of the one that was left. You're paying $629,000. That's the contract price. And in April, next year, when it settles, when construction is complete, if due to the Auckland market rising 10% over the next 12 months, it's then worth $700,000. You've paid $629,000. So one of the benefits of buying off the plan of settlements down the track is you've got the opportunity to get capital growth prior to settlement, which gives you an equity gain. So if you think about, I've got a property under contract in Te Awamutu Peninsula, $640,000, doesn't settle till April next year. 10% deposit, $64,000 I put down. If it gets 10% growth over the next 12 months, then my $64,000 has actually doubled, hasn't it? Because I've made a 10% gain, or a $64,000 gain. So by the time I sell that property, I've got extra equity in the property. So everything we do is turnkey as well. Banks don't like construction finance, and it's very hard, if not impossible, to get now for mainstream buyers. Construction finance is where the bank says, "Yep, I'll fund that new build. Here's the you'll have 5 tranches. You'll get the 10% when the slab goes down, and you'll get 20% when the framing goes up, and 10% when the roof goes on, and blah 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 blah." And so banks don't like that. Banks don't like that because if the project stalls, the banks can get left exposed with a half-completed house. Every time that the bank needs to advance more money for a completed stage, the value has got to go out there and value that it's all been done. And so also construction finance is normally quite expensive. It's kind of like a bridging finance type concept until you complete the house. Everything we do is turnkey. So in other words, you turn the key and walk in, and it's built and complete, and title's issued, and you pay for it when it's built. There's no progress payments. There's no development funding along the way. It's turnkey finance. The bank doesn't advance the mortgage until right at the very end. You pay your 10% deposit now. You come up with the other 10% before settlement by topping up, against equity in another property or cash, and then you're borrowing 80% from the bank. Generally, that's how that works. So fixed price, turnkey. I say, how long does it take to build? Most projects, if they're townhouses, are 16 to 24 weeks. House and land can be 16 to 20 weeks, weather dependent. Of course, if you get into buying in an apartment building, then that could have 6, 7, 8, 9 months of construction, because there's a lot more complexity, a lot more construction involved, excavation for basement, etc., etc. So, of our projects, I think 2 of them right now are completed and finished. You can walk in, you can see them, you can visit them, etc., etc., and they're sold and settled and occupied already with tenants. And then the balance of them are off the plan, settling any time from, I think, November, December this year through to sometime through to late next year, depending on the project. So I love off the plan in growing locations, because I know if I lock in my price today, I don't have to settle for 12 or 18 months, and I might have made a gain before I even settle the property. So that's how that works. Great questions tonight, everybody. Really, really good questions. Nick says, thanks for your reply. So hopefully I haven't missed any questions. I think I've answered everything that's come through so far. And it's been a good session tonight. And I'm glad that we ran pretty well time. Okay, Sean's got a question here. Do you assist with property management for after the purchase, e.g. finding tenants, renting, etc.? Sean, we do. And what we don't do is provide or recommend any property projects that we haven't already lined up specialist property managers for, so that as part of the process that this company said this is a rental assessment, because they're the property manager that'll manage that property for you when you settle it, so that then that's what you're going to get rent-wise. So we're not property managers, but we work with specialist property managers around the country. We generally avoid working with real estate agencies with a property management firm tacked on the side, because I always think that they've got this perverse incentive to, if they mismanage your property and you go, bugger it, that's it, I'm sick of bloody property investment, just sell it, well, then they can sell it for you and get the commission. The firms we work with, they only manage property, they don't sell property. So they generally are better at it because they're specialists, and I'm generalizing, but most of them are better at it because they're specialists. So we help arrange that before settlement, and we usually will start with you 4 to 6 weeks out with a property manager. So they're advertising for the property, getting applicants coming in, vetting tenants, doing open days. So you've got the tenant lined up ready to move in. And if you take Colombo, for example, there's a waiting list of tenants that have already not been able to get other properties that they've lined up for that are on the waiting list for other settlements as they come through. So yes is a short answer. We help with that around the country. Jennifer says, do banks give loan approvals for more than 1 year for turnkey projects? So what happens, Jennifer, good question. What happens, Jennifer, with off-the-plan projects is the bank will approve you today on that property, on the rental assessment on that property, on the cash flows, on your income today. That's what they'll do. Then what you need to do is we contact you again, or the mortgage broker generally will, about 60 days out from settlement. They'll recheck your finances. Generally what has to happen then is the valuer goes in close to settlement, does a valuation on the property, issues that to the bank. The bank says, yep, that's great, happy with that, and then settlement proceeds. So that's how that works. So a bank will give you an approval today up to, you might not be settling till the end of next year, but of course they'll just re-verify when it comes to settlement that that's the case. Well, somebody called Anonymous Attendee, wow, that's an original name, says, what if I cannot settle? So yeah, you have an obligation to settle once you're unconditional. So you put your 10% deposit at risk if you default on settlement. If the developer then sells the property to somebody else at more discount than 10% to the purchase price, they can arguably pursue you for the shortfall. And that's just the same as the settlement risk that you have if you go and buy any other property and you don't settle on it. What I will say is if you buy new properties off the plan in projects that are sold out, then 2 things usually happen. There's usually more demand for those properties, or the demand's still there as it gets closer to settlement. There's often other investors who will buy the property. And in many cases, the value's now risen. So you've got the ability to on-sell it prior to settlement and take your gain, and of course, get your deposit back as well once you assign that contract to the new buyer. So I'm not recommending go buy a whole lot of properties on the basis you can sell them before settlement and just take your money. But that's an opportunity in the rising market with the right property in the right situation, as long as 5 other investors aren't trying to do the same thing at the same time. So hence why, we would never recommend you ever go under contract and go into an unconditional contract on a property unless you plan to settle and have the ability to settle. If your strategy is to sell prior to settlement, that's a speculative gamble you can take, and you may well succeed with that, but you need to be able to settle if you have to, so you don't put your deposit at risk. So Isako's asked the same question as well. And I do know of a number of developers who have had buyers come to them, and we had one recently who said, hey, I'm moving back from Ireland. Ideally, I don't want to settle in November when the project's completed. That's later this year. Can I settle in January instead? And the developer said, yes, that's fine. So, delays happen, things happen, stuff happens. The sooner you raise a flag and the sooner that you ask for help, the better. And you should always talk to us if you ever had this situation, because we'll have ways and means that probably going to help you out in terms of helping you solve the problem, finding somebody who wants to take the project, helping you with a strategy or what have you. So never put your head in the sand when it comes to money and finances and property. Ask for help if you need it, because there's usually more than one solution, particularly if you've made a good investment at a good price in a rising market. Cool. Great questions, everybody. Thank you so much. And I am recording this session still, so we'll make this available. But yeah, in summary, just, our business is run by property investors who have portfolios, who understand the stuff, who do the stuff, who can talk about it from experience, not just because we're, academics or analysts. So don't be afraid to ask for help or advice. If you've got something you're stuck on, if you've got something you're not sure about when it comes to your existing property portfolio, or something you're looking to sell, renovate, subdivide, or whatever, we're here to help. And, we succeed by helping clients build a portfolio over 5, 10, 15 years. We want to work with you on multiple occasions. We have clients who buy multiple properties over time. We only succeed if you build a good portfolio that's profitable, that you make money out of, that helps you reach your lifestyle goals. So that's how we're measured. You can choose to work with us or not. You're not bound to anything. You're not signing up for a membership contract. You're not paying us any money for anything. We're here to help, and we know you'll take advantage of our service if it's relevant and if it helps you and it adds value to your life and you enjoy it and you think we're helpful people and good guys and girls. Then don't hesitate to contact us. So, folks, I'll wrap that up there. Thank you very much for joining me, and look forward to seeing you online again at one of our webinars or one of our events when we get back into running events again, which will probably be maybe September. But look out for a number of new project releases over the next 2 or 3 weeks as well, and check out some of those other things online I shared with you tonight if you want to just widen your horizons and get a feel for it. Rob says, have a drink in lockdown. Cheers. Thanks, Rob. I will. I've got 6 days to go now, and I'm out of lockdown, so I'm excited about that. It's not too bad. I'm probably going to get about 5 weeks work done in 2 because I can't go anywhere. There's just my desk, my bed, and room service. And I'm trying to be healthy as well. So, folks, thanks very much. Thank you. Thanks, Simon. And I will wrap it up there, and I will see you again at some stage.